Imagine hearing Warren Buffett, the Oracle of Omaha, say, "It's time." What does he mean? A man who has steered through countless market booms and busts doesn't throw out warnings lightly. This isn't just advice, it's a call to action. Buffett, a man who built his $100 billion fortune by spotting the unseen and outsmarting the crowd, has something to say. So, what exactly is he warning us about? And how can we prepare before it's too late? Stay with me as we unpack Buffett's ominous words and the wisdom he's offering for the storm ahead. The nature of Buffett's warnings. Warren Buffett doesn't issue warnings lightly. Known for his calm and measured approach, his words are deliberate, and when he sounds the alarm, it's time to pay attention. His recent message of "it's time" has sent ripples through the financial world. What exactly is he warning us about? To understand, we need to dig into Buffett's history of predicting market behavior and preparing for inevitable shifts. Consider the 2008 financial crisis. While the world was gripped by fear and markets were plunging, Buffett had been preparing for years. His strategy wasn't about crystal ball predictions, but about recognizing the patterns and weaknesses that others ignored. Before the crash, Buffett had been vocal about the risks of excessive leverage and the unsustainable housing market. When the collapse hit, he swooped in with billions to invest in companies like Goldman Sachs, taking advantage of opportunities when others were too panicked to act. His preparation paid off, and those investments generated billions in returns. Fast forward to today, and Buffett's actions are echoing that same cautious approach. Berkshire Hathaway, his holding company, is sitting on over $140 billion in cash. To most, this might seem like a waste. Why not invest in a booming market? But Buffett's logic is different. He understands that when prices are inflated and optimism runs unchecked, the risk of a correction becomes unavoidable. His cash reserve isn't just a defensive move, it's an ammunition for seizing opportunities when the market inevitably stumbles. A closer look at Buffett's messaging reveals his concern about overvaluation and economic uncertainty. He frequently references the Buffett indicator, which measures the total stock market value relative to GDP. When this ratio is too high, he sees danger. Right now, the indicator is at levels that haven't been sustainable in the past. It's a clear signal that something isn't adding up, and Buffett is positioning himself accordingly. To truly grasp the nature of Buffett's warnings, think of it as a call to stay rational when the world isn't. It's not about panic, it's about preparation. Markets have cycles, booms and busts are inevitable. Buffett's history proves that the key to navigating these cycles is patience, prudence, and the readiness to act decisively when others are paralyzed by fear. His warnings aren't predictions of doom, they are reminders of how to turn challenges into opportunities. If you are enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. The signals he's watching. When Warren Buffett speaks about market signals, he's not relying on vagile hunches. His investment decisions are rooted in a deep understanding of market dynamics and hard data. So, what exactly is he watching that's prompting his cautious stance today? To uncover that, we must first explore the critical metrics and patterns Buffett has leaned on throughout his legendary career. One of his favorite tools is the so-called Buffett indicator, a simple yet powerful measure of market health. This indicator compares the total value of the stock market to the country's GDP. Historically, when this ratio exceeds 100%, it's a warning that the market might be overvalued. Currently, that ratio is well above its historical average, even exceeding the 4-fee levels seen before the dot-com bubble burst in 2000. Back then, Buffett had issued similar warnings, cautioning that unsustainable valuations could lead to painful corrections. Sure enough, the bubble popped, wiping out trillions of dollars. For Buffett, these numbers aren't just abstract figures, they are clear signals of economic imbalances. Beyond the Buffett indicator, he's keeping a sharp eye on corporate earnings and debt levels. During the pandemic and its aftermath, we saw a surge of borrowing by companies to stay afloat or expand aggressively. While no interest rates made this borrowing seem harmless, the recent spike in rates has turned that debt into a ticking time bomb. Many companies are now struggling to manage these obligations, and Buffett knows that rising defaults could spark a domino effect, destabilizing the broader market. But it's not just data that Buffett is watching, he's also deeply attuned to human behavior. He's often said, "Be fearful when others are greedy, and greedy when others are fearful." Right now, the market is teeming with speculative behavior, from meme stock frenzies to skyrocketing valuations of unproven tech startups. This reminds Buffett of the late 1990s, when euphoric investors poured money into dot-com companies with no profits, only to watch those investments evaporate when reality set in. Consider this. In the years leading up to the 2008 crisis, Buffett observed how banks had become reckless with mortgage-backed securities, chasing short-term gains without considering the long-term risks. He warned about this well before the collapse, staying clear of the speculative mania while positioning himself to profit during the recovery. Today, Buffett is once again taking the long view. The signals he's watching are dangerously high Buffett indicator, rising debt burdens, and irrational market behavior are telling him to be patient. For those willing to listen, these signals are a powerful reminder that wealth isn't built by chasing trends but by staying disciplined and prepared for the inevitable storms. What you can do now. When Warren Buffett talks about preparing for economic shifts, his message isn't about fear, it's about strategy. He's reminding us that turbulence is inevitable, but those who act thoughtfully and stay grounded can turn potential losses into tremendous gains. So, the question is, what should you do right now to not just survive, but thrive in uncertain times? Let's start with the idea of liquidity, a principle Buffett himself champions in the wake of the 2008 financial crisis, when banks were failing and panic gripped in the markets. Buffett doesn't just survive, he thrived. How? By having cash reserves. While others were scrambling, he stepped in with billions to lend to struggling companies and bought stocks at rock-bottom prices. This boost later turned into massive profits from Berkshire Hathaway. Holding cash isn't about running to safety, it's about positioning yourself to seize opportunities where markets were down and assets are undervalued. Imagine being the buyer when everyone else is forced to sell. It's a position of power. Equally important is the principle of quality. Buffett's investment in companies like Coca-Cola, Apple, and American Express is a masterclass in focusing on businesses with strong fundamentals. Take Coca-Cola as an example. He invested in the company during a time where the market was volatile, but he trusted his brand strength and global reach. Over the decades, this single investment has brought Berkshire Hathaway billions in dividends and capital gains. The lesson? Look for companies with a proven track record, consistent cash flow, and products or services that people will always need, even during economic downturns. These are the businesses that weather storms and come out stronger on the other side. Now, consider diversification, a tool for risk management that Buffett recommends, especially for individual investors. When Buffett himself prefers concentrated bets on companies he deeply understands, he recognizes that for most people, index funds are a safer and smarter route. Think of the S&P 500 as an investment in the backbone of the US economy. Over time, it has delivered returns that outperform most actively managed funds. John Bogle, the founder of Vanguard, demonstrated that a simple strategy of consistently investing in index funds could build substantial wealth over time, even though market downturns. Buffett has often endorsed this approach for everyday investors, emphasizing its simplicity and effectiveness. Another critical takeaway from Buffett's approach is emotional discipline. Markets are emotional creatures. fear, and greed drive decisions, often to the detriment of investors. Consider the crash of 2020 during the pandemic. Many sold their investments in panic, locking in losses, while others, including Buffett, remained patient. Those who waited and reassessed their strategies were rewarded when markets rebounded faster than anyone anticipated. Patience, not panic, is the hallmark of successful investing. Buffett's mantra, be fearful when others are greedy, and greedy when others are fearful, is more relevant now than ever. So, what can you do right now? Build your liquidity. Prioritize quality over quantity, diversify wisely, and perhaps most importantly, control your emotions. Economic storms don't destroy wealth, they merely transfer it to those who are prepared to weather the winds. By following Buffett's timeless principles, you will not only safeguard your investments but position yourself for remarkable growth when the tide inevitably turns. If you like this type of content, then press the like button and subscribe to our channel.